the idea of today was just to have very much a fireside chat where it's not at all scripted. It's just very much about getting insights direct from the source from all of these panelists, with the expectation that hopefully we deliver some insights to the market in terms of the curly question of how to be successful in commercial finance and help brokers particularly to enable that why. So that was really why we came up with this concept. So as I mentioned, one of the things that I've really found has been extraordinary with this campaign that we've been running with Semper is the traction that the market has had with the whole concept of top tips. And where that idea came from was just to pick up the phone to each of these guys and say, where are you finding the market right now? What are you seeing is going on? And what tips do you have to be successful in the space? And we found that just asking that one question has just unraveled this plethora of knowledge that we wanted to really get some insights on today to share. So because that's been such a popular topic, I thought we'd start there. So Nick, perhaps we throw to you first.
Oh, great. I get to go first. So look, one of the things that we provide a lot of our brokers and referral partners is education and resources via our website. We've got a whole bunch of fact sheets and that sort of stuff, which give you an idea about what we're looking for when you send us a deal. One of the other things we recommend is who you align yourself with. So we align ourselves with groups like Semper to do our deals because we know what they do. We know how fast they're going to do it. We know they act in the client's best interest for us. We've never had a deal go bad with Semper, which is something that we really do pride ourselves in, and I know they do as well. So we've got quite a good service offering to our client as well. When you deal with Fusion, you deal with me. You have my mobile phone number. I only have one, which means when you call me at 6 o'clock in the morning, I'm likely to answer the phone, unfortunately. So we do focus on service a lot as well. So there's a lot that you can do in the private funding space. And we find that we focus on our core offering in there as well. So we've got a lot of things that we do for the brokers. We provide the education resources. We align ourselves with the quality funders, and we really do focus on our service offering.
And one thing, Nick, that I really love that you talk to is changing the vernacular about rate.
Yes, absolutely. So we don't focus on the rate, we focus on the outcome, because the outcome is far more important than the actual rate, because opportunity cost can cost a lot of money, and Andy will attest to that along the way as well. So we focus a lot more on what the outcome is to the client and a lot less on what the actual interest rate is.
And how do you find the client's expectation is with that? Do they come in focused on the rate, or is that more of a journey for them to get to a solution offering?
Well, actually, it's one of the things that we ask a lot of the brokers. It's one of the first questions I ask is what's the client's expectation on rate and fees? Because if they're expecting a 5% rate, I question why I'm having a conversation with a broker. But if their expectation is 7s, 8s or 9s, or they don't know, please tell us and we can work with the expectation, that's the best place to be, is working with the client to temper their expectation and set those on the rates and the fees that they're going to be offered from a private funder.
If you want to just touch on rate for a moment, I mean, Robbie might attest to this as well. If we take just one client that came to us that had an ANZ plant and equipment loan, 7 million, but they were amortizing it over 36 months. Now, you've got to amortize a loan that large in 36 months, it's going to screw your cash flow. You take it to a more expensive lender, but somebody that's going to treat the value of that equipment over a longer period. Even though the interest rate's higher, the actual cash out going to the companies could be much lower. So that's one example when rate is less important than the actual structure of the repayment part.
And particularly when, let's say, for example, they've taken out that loan for a project that they thought would roll after 36 months or something similar. So the cash flow suited the loan at the time. Yeah. They lose that contract or there's a downturn in that industry. But they don't want to lose the equipment because it has future value when they acquire new contracts. So, yeah, we see that all the time. You need to re-amortise debt to suit the business's cash flow as the business trades.
You know, it might be useful. I mean, we've been introduced, and I'm not going to ask you to introduce yourselves, we'll be here all night, but how many of you would class yourselves as being very new to commercial lending with a show of hands? So not too many. So how many would say that you do 1 or 2 or perhaps 4 commercial deals a year, but you're predominantly residential brokers? How many would that apply to? And the rest of you would be good commercial, predominantly commercial brokers? Would that be fair? Can I see a show of hands? Okay.
Yeah.
All right. That's a good mix then.
Yeah. And I think really that was the principle of today, that we're talking about universal themes. So anyone who's more of a newer entrant has sort of that accelerated, I wish I'd known factor. And then equally, the more mature and more consolidated commercial brokers are, again, picking up from best practice, as these guys have illustrated in their businesses. So what about you, Anthony? How are you seeing the landscape at the moment in terms of how we can provide some insights?
Yeah, I guess I'm coming from a slightly different perspective to some of these guys in as much as I'm talking to a lot of newer brokers who might be thinking of looking into the commercial space, and a lot of brokers start as a residential brokerage and they're a very good practitioner, but suddenly they're getting opportunities with asset finance, or they're getting opportunities where one of their clients runs a business and has cash flow needs or working capital needs or want to buy their premises. So my experience has been that to develop a commercial offering in your business, you've got to go from a reactionary offer to actually understanding what your commercial offering is. And what I mean by that is understanding and drawing a clear distinction about what you're going to do in the commercial space. Is it going to become part of your service offering? And then how are you going to deliver that? And the start point of that is building a really good foundation for your offer. You've got to educate yourself. The commercial space, I found my experience in building that part of the business was it's a much different mindset to a residential transaction. So you need to educate yourself about the market. You need to educate yourself about the providers and the different offerings in the market other than just the banks. You've got to educate yourself also about the sort of clients you want to work with. Are you looking at secured debt? Are you looking at working capital needs, asset finance, private lending? So there's a lot of tentacles in commercial space that you really need to make decisions about how you're going to approach that, what your offering looks like, and then how you take that to market, educating your referral partners on what you do and what you don't do, and then how you're actually going to deliver it. Because as a residential broker, I found my experience was it's a different mindset. So making a decision about how you're going to deliver that in your business, and do you get a specialist in? Do you split that part of your business off and have it as a specialised offering? Because there's a lot of residential brokers in the market looking at getting into commercial or falling into commercial just because a client has a need, which is a very reactionary approach, and it's often not delivering the best outcome to the clients because you may not understand fully what's available. To these guys' points, sometimes it's about cash flow needs as distinct from rate, and there's a lot of it's a different mindset and a different space to educate yourself on.
So Judy, I know that you're a big fan of what you call educational sprints, which I think is a fantastic concept. Perhaps maybe go into that a little bit.
Sure. So with eFunder, we have more like a digital platform and we're all real estate asset backed for funding. So I think one of the most important things is to really understand and know what you're doing in the commercial space before you have any real success. So, and that includes not only understanding your client, not only understanding your lender's requirement, but understanding the scenario in depth. So to do that, you need to be familiar with the different matrices. You need to be familiar with how to hunt out the dead bodies of the scenario, ask the relevant questions, so that the more you ask, the more is going to appear, so then you can find the answers that fit within the matrix of perhaps the lenders that you're seeking. So with education, I think it's a fantastic opportunity. If you are a new person coming, or a new broker coming into the private space or the commercial space, I totally recommend that you reach out to ourselves. We have educational series on what is private funding, how to approach the right avenue, how to approach the right questions, hunting out those special scenarios that can give you a higher success rate, which is very important.
So how about you, Nick? How did you get into the commercial space, and what did you do?
He was cooking at the time.
Well, I actually had one client that needed a commercial loan. But what I found with getting into commercial was the best part about it was I could set my own fees. So nowadays, your fees as a residential broker are dictated by the lender. Whereas now in my business, my fee to the borrower is dictated by myself and how much work I think's involved. So, I can set my fee at 0.5% for a large transaction, or I can set it at 2.5% for a smaller transaction. So it means I've been able to grow my business and my revenue without having to take on large amounts of extra work or additional staff, because I'm just able to set my own fee for what I think that deal is specifically worth to me.
We were going to talk about earlier about rookie mistakes, but I don't think it's just rookie mistakes. There's mistakes made by experienced introducers. They think that you need war and peace to understand a deal, and very often war and peace means there's a lot of skeletons hiding in the closet. I don't know how you feel, because we can sniff a good deal based on 5 bits of information. That's the loan sum, the assets, value, the loan term, the use of funds, with borrowing entities useful, of course, and then the serviceability or the exit. Now, when we talk about serviceability, that's the capacity to meet ongoing interest or principal. But an exit for a bridging loan, for example, where you're building all the interest into the loan sum, may not necessarily be something you're looking for. You're just going to build it all up, pay it out of the loan when an event occurs. That's all we need. Very, very simply put. And the next thing is quick engagement with the borrower. A lot of introducers feel that we're there to take their client from them and they're going to lose the capacity to choose where they go. If they've got it mandated, they're well protected. We're in the business for the long haul, so we're not looking to take anybody's client. So getting engaged with the borrower is the quickest way to get a decision by both parties.
And it's interesting you say that, Andy, because one of the things I always ask a broker is, can I speak to the client? Like, conference call me in. You don't have to give me their client details. Just conference call me in. Have a discussion, because I can ask 10 questions in 20 minutes that will tell me whether or not we can get a deal done, as opposed to going backwards and forwards with phone calls with you or numerous emails where things get lost in translation. By the end of that conversation, I'm able to tell you, yes, we can do it, or no, we can't.
Yeah.
So I guess, Nick, on that note, what would you encourage commercial brokers, particularly newer commercial brokers, to do in terms of that due diligence piece?
So one of the best things I ever did was I got a mandate, because once you've got a mandate, the client is yours. He's there. You know that, yes, you may have to pass him on to someone else, but most brokers are concerned about their fees. So you've locked your fee in, you've done the work, you can then pass them off to someone else to have a conversation, knowing that nothing is going to happen. So, it's very, very simple to go out and get your documentation done, but I ask some very, very simple questions. I want to know what they want the money for. I want to know the location of the asset, the type of the asset, what their exit strategy is, if they're taking cash out, what's it for? So, and then that will generally lead to more questions that we're going to ask as we go through, depending on their answers. So it turns into a 20-minute conversation. It's far easier to have that with a client than it is to have it with a broker.
And I think that's a key aspect that you're touching on. From my point of view, if you look, it's about asking the right questions, and a lot of those are going to be different to what brokers coming from a residential space might be used to asking. So a lot of it is actually about asking the right questions to get the information you need.
And what are you using the money for, right? And what comes next for us is, how are you deriving a benefit from that, right? Because we don't want to lend you $2 million for something that we can't understand without knowing you're going to derive a benefit from it. This is commercial lending. It's not consumptive. It's meant to be put to productive use, right? Because that leads to the best outcome for both the lender and the borrower.
So Anthony, I might touch on that. So we've referred to a few times that a residential discussion or a residential client requirement is different from commercial. It's wrapping your head around the needs of a commercial borrower. How did you find that transition? Or what did you start to do to then start to understand that commercial borrower's needs?
Yeah, well, I guess initially I was reactionary in truth to opportunities. I guess I had to make the decision to go, I need to educate myself on understanding the commercial space, talking to commercial brokers, spending some time with the businesses that I had opportunities within to understand their needs. And I guess there's lots of resources out there, as the panel's talked about, in terms of the sort of questions you need to ask, the information you need, how to package up a deal. And people are out there willing to help you. And as Andy and Nick said, there might be a 20-minute conversation around understanding those 5 or 6 key things that will tell you what the transaction's about. And it's a different mindset. There's often a different time frame with commercial, and it's a different type of transaction. So it really was about spending the time to educate myself, using a lot of it's hands-on experience, a lot of it is also sort of resources that you can access and educate yourself. And then you're educating your referral partners about your offering, what you offer and the solutions for their clients.
Yeah, it's a really important point you make there, because I think that everyone, as a resi broker, you have a mentor for the first 2 years if you've got very limited experience. Like, I have had people mentor me in my commercial business because it's all about being able to learn from someone that has been really successful in what they're doing. So don't be afraid to go out there and find yourself a mentor, someone that is more successful than you, that's going to be able to help you with those deals.
Yeah, and I mean, when you're in consumer lending, the asset that the lender's looking at is either a physical asset, right, or the future income. And that's the extent of it. You know, when you're in commercial lending, there's many different assets, isn't there? I mean, your future income, your receivables is one asset. Your plant and equipment's another asset. Your property is another asset, all of which can be used for security by various members on this panel to raise capital. And if you can't raise it from one area, you can raise it from another. You can.
And Judy, I know that you're a big fan of not looking at a scenario on face value.
Yeah, you can't, because there's always hidden things underneath. You know, could I just bring up a point in relation to what you were saying about mandates? And I think new brokers, often, or people in the commercial space, you do need a mandate, because for a couple of reasons, but mainly it secures your fees, and it also allows you to keep your client, but it allows them not to shop around behind your back.
It doesn't serve them any good shopping it around anyway, does it?
Yeah, I know, but at least you've got some kind of control, because you're going to put a lot of work in. So to do the work, don't be afraid of asking for a mandate. I think a lot of new brokers come in and they think, oh, shall I get a mandate, but I might lose the client if I put my fees up. Don't worry about it. It's your business. You want to increase your revenue. You want to make a livelihood, and everybody has to shine. So we're all going to make money. So let's put that aside, get your mandate, know your fees, know your structures, and go forward.
And what's expected for you to deliver as well, Julie.
And deliver, yeah, absolutely. Then look at those questions that you related.
You can't just keep the mandate fee.
You can't keep it. You've got to deliver something.
Oh, that's what we've been doing wrong.
You can't have a mandate and go around shopping and collecting all these fees, right? It's untenable. But I think that's important to know, and stand your boundaries, stand and deliver, basically.
Yeah, and I guess my mandate doesn't just stipulate what's expected of the client, it also puts in there what's expected of me.
Yeah.
I've got to deliver to get my fee. I've got to deliver to keep my fee.
Yeah, that's
but I feel secure, so does the client.
Yeah, we like to see mandates.
Yeah.
We like brokers coming to us that have mandates.
And I think also the whole notion of shopping around is quite an interesting one. And just my observation of the commercial broking industry is that brokers tend to get very excited when they see a big deal come around, like a $30 million deal, and it's landed on their desk and it's the first time they've gotten a commercial loan, and they're a residential broker, so they've made it in the world because they've got this loan that's just landed.
Yeah.
Warning bells.
It's really hard.
Warning
It is
bells.
warning bells. And look, situations like that too, when you've got such a large amount, no matter what amount, there's a lot of due diligence behind everything. But if something like that comes to you and you are a newbie, reach out.
But see,
so what should somebody do in that space? Because I've even, I'm not obviously a broker, but I've noticed that happens, that, these big deals come around. What would your counsel be to the industry when something like this does?
Why? You're going to ask why, first of all. Why is it coming to me?
Absolutely.
This is the first question.
One of the things that one of the reasons why I ask a lot of questions is because I've seen a lot of fraudulent deals in my time, whether it's statements that they've adjusted via using a PDF editing software. When you zoom in, you can tell that the fonts are different, but to the naked eye, it looks, just like any other document. So yes, I ask a lot of questions, but there's a lot of reasons behind it, because I want to know why that deal has come to me, especially when it's coming from someone that may be really experienced, or, I get deals that have gone from Perth to a broker on the East Coast, and then the broker's given it back to me because I'm in Perth. but I know the broker it's came from, and I've already said no.
Yeah. I mean, other than you, if we get a New South Wales deal that comes via somebody in WA, we're immediately suspicious.
Absolutely.
But we know that, you know, you've got a very wide network, but you can, well, how does it go? How does that work?
So, by asking the questions, you're actually going to work out what's in the deal. And, you know, I've seen fraudulent deals come from resi brokers where, you know, I have agreements with a lot of aggregators where if I see fraudulent deals, they've asked me to put in a call. Yeah. I'll call the aggregator BDMs and I'll tell them about it, because it's not that the broker needs to be, you know, I guess, told off. It's that they need to be educated about how to pick that deal next time. And most of the time they don't want to hear it from me because I've just scuttled their $10 million deal.
If you see a $30 million deal on a commercial premises in Sydney from a Saudi prince who's selling property overseas, we've seen it.
And we said no.
Robbie, did you have something you were going to add?
Well, I was just going to say on the shopping around piece, you know, you don't shop around surgeons, or I certainly wouldn't shop around a surgeon. If a surgeon was recommended to me, I would go to them and let them do what they do. In my mind, and I'm not necessarily the smartest person in the room, but in my mind, if your client's shopping you, then you haven't shown them that you're the specialist for that file, right? Either that or the client's just an idiot, and we deal with heaps of them all the time. But, you know, people are looking for specialists, whether they're looking for it, you know, in the finance world, in the medical world, in whatever area they're in. So, you know, if they're gonna shop you, either they're not confident in your ability to do the job, or they're always going to shop you. And the mandate is going to tidy that up.
Can I just say, sometimes people panic as well.
Yeah, the nervousness. Yeah.
And nervousness, so they've just got to get the deal. So, for example, it could be a distressed site that's just about to go into receivership. So the broker then panics and wants to go to 100 different people just to get an answer.
Yeah. I think that, you know,
to calm them down.
Yeah, I think you're right. You know, the greatest thing that a private lender gives you is not money; it's certainty.
100%.
So I think the important thing there for me is I don't get shopped very often because I show the broker and the client the value in dealing with Fusion. That's the big thing. They see the value in dealing with me, so they don't really want to go anywhere else.
Well, I think going to a specialist of any form, you'll get that value because they'll assist you with all the questions. They'll assist you with understanding what to ask for. Go and get the pep. With that process, you as a newbie coming into the commercial world or commercial space will learn. And as you go down the track, 6 months down the track, you'll be rattling off those questions, you'll be packaging up those deals nicely, so that when it comes to people like us, we just fix it up a little bit. And then pass it on to vetted lenders, you know, such as the Sempers of the world or whoever we need to go to.
And part of that is educating the client as well.
Absolutely,
Yeah.
Absolutely.
Yeah, and I guess, you know, for me, there's certain aspects of lending that I don't do. I don't do big equipment deals. In fact, I use Robbie to do that because, you know, I've got deals in where I just don't do them. I have my specialty and it's asset-backed securities. You know, I deal with property. I don't deal with, you know, commercial funding in asset finance. So I have people that do that for me.
And likewise, you can't be everything to everyone.
Absolutely.
If I spend all my time working on, you know, development deals, which I know nothing about, literally nothing about, there's a block of land, you know what, it's not my cup of tea. So yeah, you can't be everything to everyone. Just pick a space and really work hard at excelling in that. And you mentioned mentoring.
Yep.
You know, I'm a big believer in that. I've done a little bit of it myself. I was mentored when I started out. Lean on your lenders. BDMs have a job, and you know, don't be scared to lean on them, but also listen to them. So, you know, don't harass them. But just the common theme we've had thus far, and this is not scripted, you can tell it's not scripted because we're pretty much all saying the same thing. It's education.
Absolutely.
Everything we've said has revolved around education, whether it's, you know, the quality of submissions, it's just all been about knowing more and the yearning to always know more. So.
Yeah. No, I think it's a good point. And perhaps it's a good time to segue into some practical strategies to grow your commercial offering. So, Anthony, I might throw to you in terms of, we are talking about that education piece, but perhaps the financial literacy, which is, you know, the buzzword of the moment, what that means and why it's important in context.
Yeah, well, I think in terms of the approach of practical strategies, you've got to sort of look at the type of brokerage you want to run predominantly. A lot of brokers are just single practitioners, and a lot of brokers are now morphing into more of a business type structure. So we've sort of touched on it as a group here, but you've got to work out, how does the commercial offer fit into your business and how are you going to deliver that? Are you going to deliver it yourself? Are you going to use other resources like Nick uses Robbie for certain deals and they build a partnership there? Are you going to start a separate business unit that focuses on that space? So you really need to work out how you're going to deliver that and take the time to build that as a part of your business. Otherwise, you're going to get caught in a continuous reactionary cycle where you can't really articulate your offer. You can't even write a mandate because you're not even sure what you're offering and delivering to your clients. So it's really about working at how you're going to build it into your business, then how you're going to deliver it and articulate to your clients and your referral partners what you do and also what you don't do. And then go about educating and then go about building that offering. And that's the education piece we've talked about. Don't be afraid to ask for help. Get a mentor and be honest with yourself about the skill set you have and where you want to take that into your business.
Can I just add to that as well? And that is, if you do want to scale and you want to get bigger, know the steps you're stepping on. And I'm a great advocate of getting a business plan.
Yeah, I was going to say.
Speaking to somebody about it and knowing, so you can meet your internal milestones. Because when you meet your milestones and you re-look at it in 6 months' time, you go, wow, I've done that. I've come from here to here. And I think then the next step, you can reassess and go to your next one. Within 2 years, you've looked back at yourself and what you've done, and you've scaled. And you've got other people working with you. You have affiliations with experts or people in the industry that can assist you. I think it's a really good way of growing and educating yourself.
So I sat in on a panel a few years ago and I actually asked a room full of brokers, and I'll ask the same question here. How many of you guys did a business plan for the year? Well, that's more than what I got in a room twice this size last time I asked.
I wish I'd said yes just then.
And on top of that, who did a cash flow for the year? So every year in January, I do a business plan and I do a cash flow because that sets my fees for the year. I know what I want to be charging my clients for my services, and I also set out a cash flow so I know when I'm going to be getting my money, and it allows me to plan in my business. Am I taking on staff? We talk about clients doing this sort of stuff, but a half a room full of brokers isn't doing it themselves, but yet they want to grow their business. They want to branch out. There's a lot of things they want to do, but they get to the end of the year and they can't understand why they didn't meet their goals and objectives for the year. And it comes down to the planning that they didn't do.
And one interesting thing from our discussions, Nick, was your previous job of being a chef and managing logistics and reading balance sheets and so on and so forth. I found that sort of an interesting base for then you moving quite naturally, it seemed, into the sector. And I think of the broking market where a lot of the time there have been previous jobs or there have been previous experiences, and I just wonder whether that's being transferred.
Absolutely. So, I come from Perth. Perth has got, call it 10 or 15 hotels there. I've pretty much worked at all of them in my 20s. So I used to run hotel kitchens with multiple outlets, 4, 5, 6 outlets with 20 to 30 staff. And I would be running that myself on a day-to-day basis. So you're dealing with, multi-million-dollar operations during the year. You're dealing with, you're spending $60,000, $70,000, $80,000 a week on food. You're running functions. The most weddings, we did 4 weddings in one night out of one kitchen. So the logistics of running that sort of stuff is quite difficult. But you've got a lot of balls in the air, but it taught me a lot about being able to run my own business.
So we might actually just keep moving then. One thing that you've said, Judy, that is probably my favourite expression is finding the dead bodies. That just appeals to me at every level. So I know, you know me well, Anthony. But I think it's really a valid point in terms of really digging into that due diligence. So perhaps if you can maybe give some insight into what often happens when that process isn't undertaken.
I think there's many things that happen, but there are many dead bodies out there. But I think borrowers never tell you the truth, right? So let's just lay down the there. So what you've got to do is try to extract that truth, and how you find it, I basically say up front, I'm going to find the dead body, so you might as well tell me now.
Would you say there's...
I will find out.
I was going to say, would you say there's no malice, though? Sometimes borrowers just don't know what to tell you.
Yeah, sorry.
True.
Absolutely.
I'm trying to play glass half full.
Sometimes they don't know what to tell you. But, if you've got receivers at your door and they're not telling you, it's kind of indicative of what's going to happen next. So you have to really, there are those specific questions, and rightfully so. Andy pointed out there's usually about 5 questions.
Yeah.
And we have that as part of our portal. There's these 5 questions we set out, and you just answer them. But when you just answer them, don't just ask, like, the purpose of the loan. The purpose is to buy a piece of land. I want to know what happened.
Where is it?
I want to know a bit more about that. Why are you buying that piece of land? Is it because you have to leverage off somebody, or are you getting money from this and you need extra funds to cash out on something else? I need some explanation.
It's a good point, Judy, because, as an introducer, if you don't ask the question, you're not going to have the answer first and foremost.
I'm not.
And then you're going to be embarrassed when it gets asked by the lender, right?
Yeah.
And then we often find ourselves in an adversarial situation where we've now got an introducer that's protecting information. So we've got to get around it. So it's a partnership at the end of the day. You're only going to help the client if you let the client help themselves. So you've got to ask the question and follow those rabbits down the hole,
Yeah, exactly. So I think it's important that, once you've found all these questions and you're asking, you might have those 5 questions. The amount, the purpose, the transaction summary, what's the history behind it a little bit. No, we don't want war and peace, but we do want some solid information. Because please remember that giving it to a private like an investor or a lender, they have to analyse your words and your scenario, and they have to base a risk assessment on it because they want to know when they're getting their money back.
Well, it's one of the most important things.
It's not lent until it comes back.
Getting the money
It's a
out
gift
was
until
easy.
it comes back.
You've got to know, yeah. So, and that's all about the rate assessment and the risk assessment and everything else that goes with it.
Yeah.
So the more information you can find, and rightfully so again, Anthony, you brought up asset and liabilities. That's a fantastic
A&L.
starting point, an
Yeah.
A&L.
Let us know all your assets and liabilities.
Yeah.
It gives us a really good picture
Yeah.
in your financial health, right?
Yeah. Sorry.
We had one today, just on a light note. My business partner's up the back, and he was laughing because we had an A&L come in from a customer, and it had, all the assets or liabilities. And one of the assets, it had a block of land, $5 million.
Yeah.
And so Greg called them up to say, just need the details of that block of land. Is it rented? What is it? And the borrower came back and said, oh, no, I'm planning on buying it. I want that block of land. And we're sitting there going, well, you don't have it yet, mate. You can't put it on your A&L.
It needs to be on both sides of the balance sheet, mate.
I think Greg's exact words were, he looked out the window and went, well, I'd like that building. Can I put it on my A&L? I was like, well, so just, clarifying the A&L.
Yeah, just on the A&L, exactly. We had one the other day that had 8. He said, I've got like $70 million worth of assets. I went, that's amazing. Let's have a look at the asset sheet, and it was all on option. So
That's not an asset.
an option is not an asset.
It's probably time
it's
for
a prayer
Kieran.
that you're going to settle.
Probably time for Kieran's favourite. We had a call one day, and this guy's on the phone, and we said, "Do you have any property?" "No, I don't have property. Got some exotic birds." I said, "What?"
What?
Kieran, I got a guy here with exotic birds. He's going, "Yeah." I said, "Yeah, they're really exotic." He said, "They're parrots." And I said, "Parrots, Kieran?" He's going, "That sounds like a flight risk." That's a true story.
I think while we're on that financial literacy piece, which is a little bit off the topic, but just while we're talking about some of that, the other important aspect to understand as you're getting into the commercial side is understanding the cash flow cycle of the businesses you're working with and where those pressure points are from a cash flow perspective, and then also understanding the sort of solutions you can offer the clients, because a lot of them don't know what the solutions are. A lot of them just think about the major banks. They don't understand the depth of solutions that are on offer.
There's never been more solutions out there on the market. I mean, I've got relationships with 80 plus private funders and investors. And one of the things I always talk to brokers about is, not only do I have a relationship with brokers, I've also got a relationship with funders. Now, I don't want to burn a broker because they refer deals to me, but by the same token, I don't want to burn a funder by giving them a deal that's full of crap, because it will get found out, and you didn't send the deal there, I did. I ask a lot of questions based on that because I've got those relationships and I don't want to burn them.
You're an important filter part of our work, right? That's what makes our life easier when you've got an introducer that knows how to filter the crap. Otherwise, we kiss too many frogs.
Well, and one of the things that we say all the time, Andy, is it's easy to get the money out the door. Getting it back's the hard part. And that's why the exit strategy is so important. It's because getting the money back is the hard part.
Yeah.
So just further to what you were saying, Nick, and I completely agree, in terms of just the plethora of different financial options or commercial finance options, it's how you comprise that. And one thing that you said, Robbie, which I love as a new term, is asset stacking. And I think that also speaks to the evolution of the industry rather than looking at a single product or a single lender. Perhaps go into that notion of asset stacking for sort of a more mature commercial broker?
It's when we were discussing just the different products that are out there, and I specialise in business lending, and we're sitting there going, okay, so a customer, and a little bit of this is the education piece as well. A customer will come to you and they'll say they need money, and what they want you to do is go to your lender and say, this customer needs $5 million. Please give them a loan for $5 million at the cheapest interest rate that you can give it to them at. And then that's great, but that customer runs a mildly successful civil works company. That customer's never worked in finance. So, I'll sit with that customer and say, look, I appreciate you need $5 million, but let's have a look. Is it for asset acquisition? That's easy. Okay, so now we're talking about leasing. Is it to shortcut through your cash flow or speed up your cash flow cycle? Well, now we're discussing debtor finance. Or when we're talking about asset stacking, is it just genuine working capital and we can't offer you debtor or we can't offer you trade or anything like that? Well, let's take some of those assets that you've got that are sitting on the balance sheet and release equity from them. And it's just about really taking the time to understand. Now, don't get me wrong, what I've just described, you might use all of them for one customer. So you might end up doing 7 different facilities with 7 different lenders and getting paid 7 different lumps of brokerage because we don't do it for free. But at the same time, it's you as the broker's financial or market literacy to know exactly what's out there and how to put it together. And then, having relevant partnerships with relevant funders, relevant, valuers and auctioneers, and just being able to really come to them give your client a really, really detailed offering on the best way to achieve what they wanted, which they just wanted $5 million. But no, we've given them.
And you need the collaboration between the different types of asset stacking providers, right?
Yeah.
As an example, we may have a property that we're willing to lend 70% on, but they actually need to go to 80%. But they've got a large, debtor receivable book. This has happened before.
And we'll shore it up.
Yeah, go and we shore that up. But then you've got to have the collaboration because the debtor financier wants us to be light on the PPSR. Okay, we've got the property, but we want us to be light on the PPSR. They want us what's it stand for? The
National Property Security Register.
Yeah, thank you.
Right. You made me look good, you said.
I can never remember. I remember when it was just the car, the car registry. But so you've got the property. Lender's got the property. Normally, you would take a first charge position against the company in PPSR, all PAP, right? But in this case, you've got a debtor financier that wants to be first there, and he might want a second behind you. So you're collaborating. You're providing the solution. The great thing there, of course, is the debtor financier sees the cash flows and is paying your interest out, sweeping it every month. So it really does work as a good collaboration.
I think sorry, I can just add. I think one of the important tools that a commercial broker should have is learn how to strategize.
Yeah.
Not only in debt stacking, but also in scenarios. The beauty of private funding is when the banks do say no or they take too long, inevitably, that when you go into a scenario, you can always come out of it. And it might take you 3 or 4 times to come out in a private scenario space before you do go back to the mainstream. So I think having a strategy and understanding the different strategies you can approach the different deals and scenarios will get you some wonderful solutions.
Yeah,
well, you see this because they come to us and the broker said, well, we think this is a bank deal.
Yes.
So, okay, well, I've had a look at that. And you have, but this has got time constraints.
That's right.
And you're not going to get it through the bank. So you need to take a 2-step approach here. Yeah. We can provide the immediate solution. While you work on the bank exit, we'll work with the banks too. So
And
solve the problem first, and you've got the time constraint. Realize what's driving and motivating this.
Yeah, I agree. I think also too that, I think banks are coming. I've heard all about them. I had meetings with them, and they are coming back with vengeance. But I do not think that there's no room for the private market because of time. And I know in myself with developments and things like, the bigger projects, which is my area, by the time you've put it through the bank, it's 8 months before you're going to get some kind of approval.
Yeah.
And after month 6, they've usually changed their policy, so they're going to have to
for
go back to
pre-sales
square
also?
one. Whereas with the private funding,
Yeah.
you can get it done within the 6 weeks or 8 weeks.
Perhaps that's a good segue just to talk about the current landscape. And I know, Andy, that you've got views about commercial lending, commercial finance, the evolution of that. So perhaps we just conclude on that before we go to Q&As.
Yeah, first of all, we hear a lot about the RBA stacking, cash onto balance sheets and the banks being ready to lend. And the whole plethora from the mainstream banks right the way to Judo, for example, have benefited by an abundance of capital. But they're not getting it out to the SME market. It's just not going there. And I think a large amount of it has some treasury function related to seeing the margins come down. And we're historic low interest rates. The margins are very, very limited. So if you're going to be applying a large amount of capital on your balance sheet, you're looking for the slimmest risks you can. You want to deploy that to the slimmest risk area. So there is a large number of SMEs with good assets, good reasons to borrow, who are talking to banks and ordinarily should, but the banks are not listening. They're not there for them within the time frame that they need. And we use an acronym DUO that describes perhaps the type of borrowers that come to us. The D is deleverage, so they've got too much debt. It's strange in this market when interest rates are so low, but they may be on a higher rate of interest by nature of the fact that their income has suffered through COVID. They need to deleverage. We can help them deleverage. The banks usually got a little bit fed up with them, so we'll help them deleverage back to serviceability before they go back to a bank. You've got the U, which is unbundling. Typically, businesses might be with one bank, and they've got them strapped up across all their assets, and they want to extract some equity, but the bank says, no, we're quite comfortable during this time where we are. So someone like Nick or other introducers bring them to us, and Nick will then take each asset to a different lender and unbundle them and take asset income that way. And the last one is simple. It's the opportunity borrower, somebody who's taking advantage of somebody else's disadvantage, which unfortunately we're going to see more of. But they need to do it quickly because the person selling needs the money quickly. So the person buying does too. And that is suited to the bespoke lending space that we're in. I hope that answers perhaps my take on it.
Great, thank you. Well, perhaps we'll just throw to the floor. Is there any questions? Oh, no questions.
Done.
We did a great job, didn't we?
Great job.
Everybody's going, there's beer. There's beer out there.
Well, if there's no questions, we've had a few questions come through just from the virtual event. So one of the questions from South Australia is, what is a typical type of deal that you'd write? So just to the brokers, that what would a typical type of deal be that you'd see in the commercial space?
Sorry, I'll start. For an example would be, I've got one at the moment that's residual stock. They're just finishing off, they're coming out of their construction facility and they need to come out, so it's 65% LVRs on residual stock. That's an example. Just give one more example. Another example would be we've got a 50% on a house in Carlton, and that's just a vanilla loan, like just a normal loan that comes through, but they just can't they're on notice to complete. The bank hasn't approved it yet, so they've come to us for assistance.
And I think that's an interesting point because I think the market expectation is that commercial transactions are always complex, but they're perhaps not always that way.
That's correct, yeah.
How about you, Anthony? What type of...
Yeah, a lot of my clients are small business owners, so we often tend to see initially working with those clients, they might be looking at buying a premises or some secured debt, but that will often then lead to you're looking at their balance sheet. They might be looking at growing their business, so it might lead to asset finance or even cash flow and working capital finance solutions. The other area we're seeing a little bit of is business owners buying larger parcels of their actual business and different ways of structuring that. That sort of solution as well for someone looking at either buying a bigger shareholding in their business or buying into the business they work in.
How about you, Robbie?
We'll do anything from just your general asset acquisition, a little bit like yourself, cars are your easiest one because they're on the road everywhere. We'll do everything from there all the way through to the weird and wonderful. We might raise capital to pay out the ATO or work with an administrator to pay out a deed of company arrangement. So we certainly do play in that, the insolvency space as well. Cash out against directors' residential properties, either due to distress or due to the business going through growth periods. And as we've touched on, just anything asset or business working capital related is sort of G&H's little space.
So of our 4 main product types we deal with at Fusion, being our second mortgages, construction funding, our land banking, and our normal commercial lending. The one thing we're seeing a lot of at the moment is land banking. There is a lot of land banking. I've had 6 deals come in this morning, purely just off land banking. So the land banking and residual stocks seem to be big in the market at the moment. I am still seeing a little bit of bank grade commercial, but that is where we're seeing the vast majority of our deals at the moment.
Okay, well, I've got another question that's come through from Tristan. And this perhaps is a question for you, Judy, or perhaps Nick. What LVRs are you seeing on construction, GRV and TDC, and what rates and typical covenants?
That's a big question.
Yeah. Where do we start?
Broad, very broad.
Depending on the construction facility, right? So I'm going to make a sweeping statement because there's no deal in front of me. So usually around about 65% or 70% of your NRV. So the GRV 65%, coupon rate would probably sit between 5.5 to 7.5. Line fee would probably sit between 1.5 to 2.5. And a stab fees are 1.5 to 2. And then you have the brokerage, which is obviously
5.
Yeah.
Sorry, I was waiting to ambush you on that.
That's just on average. That's, it depends. There's a lot of variables in that question.
No, fair enough.
So look, I'll cover that off. I'll give you 2 quick examples. We're actually doing a deal in Sydney in Wahroonga. We've managed to pick that money up at 6.5 with a 2% line fee. It's very, very cheap. There's a 2% stab fee on that. And I did one in Townsville, which we got an offer on late last year. Now, that one there was at 7.5, no pre-sales, 2% line fee. And look, with private funding, you talk about the covenants. Generally speaking, the covenants are nothing like a bank. Most of my deals are done on a no pre-sale basis. If you get pre-sales, that's fantastic. Rolling them through the deal is always best. We don't necessarily want you to have pre-sales to start construction. You're discounting the end value of your stock in a rising market. Now, no developer wants to do that. They want to be able to sell them in 12 months' time and maximise their amount, because if they can make 30, 40, 50 grand, that's pure profit. It's on top of what they thought they were going to get.
I heard you had a great one in Bacchus Marsh.
Yeah, that one there's coming too. So, and actually that one there, 795, no line fee, provided by Semper. So that one there's a great deal. It's a 1.5 app fee, which you're not seeing very often these days. And the brokerage we got skinned on, but
doing no work.
That's the way it goes sometimes.
All right, so we've got another question that's come in from Alex, questioning why business funding still seems so hard to get when money is cheap.
Because a lot of businesses aren't doing as well as what they could.
I don't know if money is that difficult to come by. I think if you're looking for, if you're a prime borrower looking for a residential mortgage, it's very easy to get access to money at the moment. But I've got a feeling that a large amount of that money sitting on banks' balance sheets is there to shore up something other than lending to SMEs. Well, it's not filtering down, is it?
And I think a big point to make there is on that question, a lot of what they'll be referring to is unsecured debt. Unsecured debt is hard to come by. If you've got a residential property that you can leverage off or a commercial property you can leverage off, you can get the money. But it's unsecured debt that everyone keeps coming to me saying, can you get me 250 grand unsecured on a business loan? Well, then it all comes down to the strength of the business, and that gets really hard.
Yeah, balance sheet as well.
Yeah.
And the banks tend to want bricks and mortar.
Absolutely.
Yeah.
And a business businesses have either needed cash for cash flow through the last 12 months to either survive or to grow, and they want it fairly quickly. And the banks, from our experience, haven't really been supporting the small business market in that sense, even though they're out there getting the government guarantee loans. It's been very tricky to navigate.
Well, yeah, and you're seeing a lot of confusion in the market, deliberately so, in my opinion, a little bit from a way it's been reported in the media. There's plenty of money out there and it's cheap. And it's a little bit of a good news story for businesses. Guys, there's money out there, there's government guarantees. We didn't want to make today, or I didn't want to make today about a COVID thing, but there was some stimulus and there was money out there and it's still there, but it's not being lent out. And the businesses it's going to aren't the businesses that are knocking on our doors saying, money's real cheap, why can't you get me cheap money? I don't think if I saw more than half a dozen, me personally, not the whole of G&H, it's quite a few of us, but I saw more than half a dozen customers that actually successfully got a SMEG loan, SME guaranteed loan from the bank, I'd be surprised. We could write them, but the businesses that qualified for them didn't need them. If you were making face masks during the pandemic, you didn't need a government guarantee loan. And then the businesses that did need it because they'd had a relevant downturn, they just didn't qualify. And I don't think they're going to qualify for a long time.
Yeah, a lot of the narrative is just spin.
Well,
So I think we had also a question from the floor.
Yeah, hi guys, thanks so much for your time. One of the things that I wanted to know is valuations, from a bank val to a private lending valuation and how that differs, and what you guys sort of see when you come across a bank valuation that isn't on a private lending panel.
I can answer that. There's a very big difference between a bank val and a private funding val, and one of them comes down to the value of PI for a start. The PI to do a private funding val is about 3 times the price of if you're just doing banks and non-bank lenders. So that means the price of that val is also significantly more expensive. So that's the first point. And on a private funding valuation, everyone seems to think it gets done at a fire sale, which isn't exactly correct. You get it valued at market value because the comparables are still there. They're in the valuation. And I mean, I'll always ask for a copy of the val so I can read it. So there's not a lot of difference, but then they may be saying that, we will then discount it a little bit for risk and it may come in 5 to 10% less. But it's not a significant difference. But a lot of that is based around also the valuer that's doing it. And we all know valuations are subjective to a certain degree. If you give me a bank val from Optium or something like that, some of my funders will take those. M3, they'll take those as well. But if you give me one from a backyard valuer that doesn't even have a website, no one's touching it.
I think also too with the valuation, you've got the instruction coming from the vetted lender. So with a bank, I think they've got their own policies, but individual when it comes to private funding, they've got their individual policies, they've got their criteria, they're going to instruct a certain way. So that's a huge difference.
Yeah, the value
especially relating from second mortgages to senior debt.
I think we might have another question on the floor.
Yeah, hi guys, thanks for your time. My question for you is, with inflation inevitable with the amount of stimulus which has hit the economy and the subsequent increase in interest rates, how do you think that's going to wash through the private lending market?
You want to start with this one?
Yeah, I'm not sure that it will. And I mean, if we see inflationary effects on the market, they'll have to be dealt with at a macroeconomic level. I'm not so sure that they will impact the private market. Our margins are larger. Our LVRs are generally lower. We only lend on one type of asset, and that's property. So we don't have a concern about risk-weighted ratios across many different loan products. So and we're fairly short-term. We can restrict the term that we lend against. So we're pretty well set against any market movements there. What would be terrible, I think, would be to allow the property market to keep on moving at the rate it's moving with the supply of free money, because it is basically free, and see all of our financial institutions and banks beholden to what has become a new gold standard, and that's the property market. There needs to be some dampening, and I think the RBA will take some steps to do that.
And we've got time for one last question, which has come through from Kate. Further to your point, Robbie, what are the best finance options for SME clients following the end of JobKeeper? And perhaps that also relates to when we talk about asset stacking, what types of finance solutions comprise that term?
There's no one answer, because what is applicable to a consulting firm is very, very different to what's applicable to a pub in Melbourne that was shut forever, that is applicable to a landscaping company. So when I get a file and we're talking about a working capital solution, I'll generally look at it in this exact order, and this order is based purely on pricing for the customer. I'll look at, and don't forget I do more asset than property. So I will look at unencumbered plant and equipment, if applicable. So that's obviously a lot easier with wheeled goods. From there, I will have a look at whether I can do receivables finance for them, because I find that really, it really works. First of all, generally it's not property backed, and second of all, the way the debt churn works, it can be really cost effective. From there, either I'll utilise those and then go into a third, or if they're not available, I'll look at your traditional. I'll look at your fintechs. The reason I said traditional is they haven't been around for that long. But you look at your fintechs and your 12, 24, 36 month loans. So horses for courses. What is applicable to each customer depends on what that customer does and what they've got available for us to utilise.
Okay, well, thank you very much, everyone, and thank you to the panel for doing such a wonderful job today. I hope you found it a little bit insightful, and we'll be around afterwards if you have any questions.
Cheers, thank you.